training course. This is the fourth of 4 videos on trading tight bear channels. The single most important thing for you to know is if the channel is tight, only sell, do not look to buy. As the market continues to make a series of lower highs, trail your stops down, and always have a plan to take profits because channels eventually end. This is the euro versus the Japanese yen 5-minute chart, and obviously a very tight bear channel. At some point, you decide that it's a bear trend, that it's going down. And when you do, then you know there's a 60% chance that it's going to go further. You don't know how much further. It may go a lot further, but you know at some point in here that you're in a bear trend and that you have to sell. It never feels like it's 60% certain, but whenever you look at a chart and you see a bear trend, you have to assume there's a 60% chance it's going to go further rather than reverse. And 60% is about as good as it gets as a trader. And if you're a trader, you have to trade, you have to sell. The easiest way to enter in a bear breakout like this, or in a bear channel like this, is simply to sell the close of a bear bar or a follow-through bar. Here, the follow-through bar came 2 bars later. And when I say sell the close, I mean several different things. The easiest one is as soon as the bar closes, you hit sell the market and you get filled right around the open of the next bar. Or alternatively, right before the bar closes, maybe a second or 2 before, you hit sell the market and you get filled right around the close. A third way to do it is as soon as the bar closes, place a limit order to sell at the price that that bar closed. And you usually get filled on the next bar, but you don't always. Sometimes the market falls immediately and never goes back above your limit order. For example, here, when this bar closed, you place a limit order to sell at the close of that bar. This bar never went above that close, and you would not have been filled, and you would have missed at least 10 or 20 pips down a scalp. The best option for most traders is when you have a strong bear bar and a bear trend and you're flat and you're wondering how to get in, just sell the market right around when the bar closes, a second before, as soon as it closes, or a second after. And whenever you do enter, look to the left for the most recent major lower high. A major lower high is a high that followed a decent bear breakout, a decent series of bear bars, at least one big bar or 2 or 3 smaller bear bars, and usually a new low, but not always a new low. Another choice is you can sell above the high of the prior bar because you know any reversal is minor, which means the best the bulls get is a rally that becomes a bear flag or a rally that becomes part of a trading range. In either case, the odds of making money are good and the odds of losing money are small. You can usually either make money or get out around break even. The bulls are trying to reverse. Bears will place a limit order to sell at the high of this bar as soon as that bar closes and they get filled on the next bar. As soon as this bar closes, you place a limit order to sell at its high. You did not get filled. You place a limit order to sell at the high of this bar. You did not get filled. You place a limit order to sell at the high of this bar, and you finally get filled. Again, if you cannot decide how to get in, or if you were hoping to sell above the high of the prior bar, and for some reason you were distracted and you did not get short above the high of this bar, simply sell at the market. I have other ways to get in on the next slide. It's natural for beginners, when they see a bar that looks like this, to become afraid to sell. However, look at the bars to the left. They're in a tight channel, and therefore, even if you have a good bull breakout bar, or a good bull reversal bar, or even a big bull bar, the odds are it's going to fail and either become a trading range, part of a trading range, or a bear flag and the market will fall further. As long as you rely on your stop, for example, if you sell here, the most recent major lower high is right here. You'd have a stop 1 pip above it. As long as you rely on your stop, the math is good for selling. If you don't want to sell a bull close, you can sell on a reversal down. This is a small wedge bear flag. It went up, it went down, it went up, it went down, it went up, and now it's starting to go down. You can sell on a stop below the low of that bar. A lot of traders prefer only to sell below bear bars, and here we have a small pullback. The market's channeling down, tried to pull back. Traders will place a stop order to go short right below the low of this bar, and they'll get filled here. That's a low 1 bear flag. This is a low 2. It tried to go down, failed, tried to go down a second time. The reason why low 2s and low 1s work well in bear trends is because those are the places where the bulls give up. If you're a bull who bought here, hoping for a reversal, you'll often allow the market to go against you one time, but you'll rarely let the market go against you a second time when the bear trend is strong like this. And therefore, the bulls will give up. And the bears know that, and the bears will sell, betting on a resumption of the bear trend. You often have several choices for stops. If you sell anywhere in here after this breakout to new low, traders will use that as a stop. If you sell here, you might use this as a stop because it's a wedge bear flag and a double top with this big sell climax bar. It should not get above the high of this bar. But if you sell here, it's probably better to put your stop here or here. If you sell here, you might be able to put your stop here because then it's the neckline of a double bottom. And if you're a bear, you don't want it to go above that neckline. An alternative would be to put your stop here or even here because the market might be in a trading range, but a trading range in a bear trend probably will have a bear breakout. If the trading range goes on 20, 30, 40 bars, then it's 50-50 whether you'll get a reversal up or trend resumption down. Here, you see what's going on here? We're trying to rally. It's testing the high of the most recent sell climax. It's also testing a breakout point. This is a big bear bar breaking below a prior low. It's a breakout point, and this is testing that breakout point. It's a stronger bear trend if there's a gap, but here there's a tail with not much overlap, and the market's reversing down. So it's testing the breakout point, and the bears are winning. Here, there's a gap. Look at the breakout point here. We have a breakout point here, a breakout point here. The bulls try to test it. The bulls try to reverse again. Cannot get back above the breakout point. The bears are very strong. The odds are this is going to lead to a measured move down. Bears like to sell when the market's in a bear channel in the middle third of the prior bear leg. The market sells off. It's trying to reverse. Here's the middle third. So some traders will place limit orders to sell 50% pullbacks. When the market starts to go up here, they'll place a limit order to sell halfway up, and they'll get filled there. Many bears will be willing to scale in 10 to 20 pips higher. Here, after you sold, it only went 5 pips higher, so no one's going to scale in. They'll sell here, rely on their stop, and swing part of their trade. They might scalp out part, but it's really a better swing trade. 10 pips below this is probably somewhere down here. That's a strong breakout, or at least it's in the process of breaking out strongly. And it's better not to scalp out, wait to see what happens. And then once you see 2 big bear bars and a bad attempt by the bulls to reverse, it's better to keep holding on for a swing trade. Whenever the market's in a bear trend, 80% of reversal attempts will fail, and the market will either continue down or go sideways. And therefore, traders will place limit orders to sell at the high of the prior bar, betting that the reversal will fail and the trend will continue down. Traders do not take all of these entries that I'm talking about, but if you're looking for a way to get short, any of these is a reasonable choice. This is a breakout. As soon as it has a reversal attempt, a pullback, you have to assume it's in a channel. This is a channel the whole way down, and within the channel there are breakouts. Channel means there are pullbacks, and tight channels have frequent pullbacks. Every few bars the market's trying to reverse. And that gives you a lot of opportunity to sell above the low. Do you have to sell at this price, the very low of the day? No, because usually there's going to be a pullback. Here we have a strong bear breakout, consecutive big bear bars. You can sell at the market as these two bars are forming, or you can sell the close of that bar, or you can wait for a pullback, or sell above the high of a prior bar, like here or here. Lots of opportunities to sell above the low. You can sell pullback to resistance. I don't have a moving average drawn in here, but traders would sell at the moving average. Also, I do not have a bear trend line drawn in here, but the bear trend line would be the top of the channel. Other traders will place a limit order to sell around the bear trend line, or they'll simply sell at the market at the bear trend line, or on a reversal down from the bear trend line, or on a reversal down from any resistance. Here's a bear trend line. Some traders will place a limit order to sell at the line, or a market order to sell at the line, or on a reversal down from the line. You can draw another bear trend line here, and the same thing. Sell at the line or above a prior high, or at a bull close, or on a reversal down on a stop. Again, same thing. Bear trend line, trying to break above it, its resistance. You're betting that either the market will continue down, or the best the bulls will get is a minor reversal, which means a trading range. And that will give you time to get out, break even if you want. You usually can make a small profit. The odds of a minor reversal becoming a major reversal without first becoming a trading range are small, probably less than 30%. Even this reversal is still a minor reversal. It turned out to be a very big reversal, but it was probably still going to be a minor reversal. It's a lower low major trend reversal. It could lead to a bull trend, but at this point, maybe only 40% chance it's going to lead to a bull trend, 60% chance the best of the bulls will get is a trading range. I said 40% chance here because it's a small lower low major trend reversal. Small, only 3 or 4 bars down, probably minor. The pattern is too small, not enough bars in the entire pattern, usually to lead to a major reversal. Usually, when the pattern does not have many bars, it usually becomes a minor reversal. We have a two-legged pullback, which is good for the bulls, and the sell-off is only a few bars, and usually you need more bars in the sell-off for the pattern to be major. You can always sell on a breakout below a prior low. For example, if you see a reversal here, you know the bulls will have their stop right below this low, and therefore you can place a stop to go short 1 pip below that low, and you get filled here. You can sell below that low, and you get filled there. However, in a channel where there are lots of reversals, the bears prefer to sell reversals above the low, and they tend to use prior lows to take profits, or at least partial profits. In a strong breakout, traders will sell far below the prior low. For example, they'll sell at the market during this breakout. When the market's starting to get pullbacks, it's in a channel, traders tend to sell above the prior low, and they take partial profits at the prior low. Again, as I said, it's a very strong bear trend. It's a breakout on the next higher time frame chart, for example, like a 60-minute chart, and therefore you can sell at any time, including at the low. All through here, the market's at the low of the bear trend. You can even sell this follow-through bar. We have a bear breakout and then a bear close on this bar, so it's a good follow-through bar. You can even sell here, knowing that if you manage your trade well, the probability of making money or at least avoiding a loss could be 70 or 80%. You have to use the correct stop. The most recent strong breakout is here, and therefore this is a reasonable stop. Could you put your stop up here? Well, you probably can. I would not. We're starting to get trading range price action. And if this is the start of a trading range, the market tends to go above minor lower highs, yet it does not reverse. And therefore, this is probably a better location for a stop if you took that sell. Again, traders don't want to be selling at the low, especially late in a bear trend. However, even if you do, the risk of losing money is small, especially if you can manage your trade well. By managing your trade, I mean use the correct stop, preferably be able to scale in, and then get out if you think the market has transitioned into a trading range. We have two legs up, so it's a double top bear flag. You can call it a triangle. 3 pushes up, 1, pull back 2, pull back 3, and we're getting a bear breakout. You could sell either below the low of this doji or below the low of that bear bar. However, a triangle late in a bear trend usually becomes the final bear flag, which means the breakout usually only goes a few bars and then you get a reversal. A bear who did sell here at this point is disappointed by the number of bull bars closing near their highs. We're starting to get a bull bar here, here, and we're starting to get bigger bull bars. The market's probably transitioning from a bear trend into a trading range, and therefore traders will change how they're selling. Instead of selling at any time, including selling low, they want to sell high. In a trading range, you want to buy low, sell high, and that's true for the bears. They want to sell high, and they want to buy low. They want to buy back their shorts near the bottom of the range. The seller closed bear who did take this sell, he would scale in higher, for example, 10 pips higher maybe. In general, if you're scaling in, you want your second entry to be at least the size of a scalp above your first entry, so that when it gets back to your first entry, you get out break even on your first entry and a scalp on your higher entry, your second entry. In the Forex market, the minimum scalp is 10 pips. And therefore, if you're thinking about scaling in after you took this short, you want to make sure your second entry is at least 10 pips above your first. If it never goes more than 10 pips above your first, you do not scale in. And if you're disappointed by the number of bull bars closing on their highs and you want to get out, you simply get out break even instead of waiting for a 10 pip profit below. The sell zone, the area where bears look to sell again, in any bear channel, whether it's very tight or very broad, is in the middle third of the prior leg. If the market reverses up a third to a half of the prior bear leg, or a third to 2/3 of the prior bear leg, bears will start looking to sell because the pullback will usually reverse down after that kind of a pullback. Here's a bear leg. This blue box is the height of a 33% pullback. This green box is the height of a 50% pullback. Bears would like to sell at least around the height of that blue box, a third of the height of the prior bear leg, and preferably half the way up from the prior bear leg. So somewhere in this middle third of this most recent bear leg is where the bears would like to sell. The same here. A bear leg, traders like to sell in the middle third. This went above the middle third, but they still prefer to sell in the middle third. You can sell with a limit order around 1/3 of the way up. You can sell with a limit order around half of the way up. If you prefer, once you get the market a third to a half of the way up of the most recent strong bear leg, you could sell with a stop on the way down. You could place a stop order to go short right below the low of this bar, and you get filled here. Same here. You could place a stop order to go short below the low of this bull bar right here. However, consecutive bull bars, one of them being very big, the odds are we're going to get a second leg up, and therefore it's better to not sell on a stop below this bull bar. It's better to wait for a second leg up like this and then sell. When a channel is tight, it's tight because the legs up are small. And that means usually they only last 1, 2, or 3 bars. So what do traders do? They place a limit order to go short at the high of the prior bar, betting that the pullback will only last 1 bar before reversing down. They'll sell above the high of this bar and went up several more bars, but it did not reach the top of the most recent major lower high, and therefore they hold short. Here, they could sell above this bar, sell above this bar, 1 bar pullback. Here's a 2-bar pullback. They don't know it's going to be a 2-bar pullback, but a lot of traders will sell with a limit order at the high of the prior bar, and they did not get stopped out. Even here, if you used a stop up here at the top of that tight bear channel, you would not have been stopped out had you sold at the high of the prior bar. Other traders, especially later in the trend, believe pullbacks will start to get greater. Instead of selling at the high of the prior bar, they'll sell above the high of the first pullback bar, betting on a 2 or 3 bar pullback. And that's what took place here. Instead of selling at the high of this bar, some traders will sell at the high of the first pullback bar, the first bar that goes above the prior bar. So they'll sell here, the second bar up. Same here. Instead of selling at the high of this bar and getting filled here, some traders would prefer to sell above the high of a 2-bar pullback, and they'll place a limit order to sell above this bar, and they'll get filled here. And other traders like to sell 3 bars up. So we have 1 bar up, 2 bars up. They'll place a limit order to sell above the high of that bar, and they'll get filled up here, or they'll get filled at the high of this bar, on this bar. I drew this pink box higher up than at the high of this bar, simply because if I put it on that bar, it would be hard to see. No one's taking all of these entries. It's a bear trend. You have to get short. These are all reasonable ways to get short. Here, there are 3 reasonable alternatives. You're not going to take all 3, but if you're flat, it's a bear trend, you have to get short. Take one of them or sell with a stop on a reversal down. Sell climax. The entire leg here is very tight, and therefore it would be a big breakout bar or 2 or 3 big breakout bars on a higher time frame chart. So pretty climactic. And now we're getting a strong reversal up. Even with a strong reversal up like this, when the channel is tight, the best the bears will probably get is a trading range. However, when you're getting a strong reversal up late in a bear trend, especially when it's fairly climactic, this is extremely tight and a lot of bars and therefore climactic, the market might be transitioning into a trading range. If you're a bear and you sold anywhere in here, and then you see a bar like this, especially when there's a follow-through bar, you're disappointed by the price action. You're disappointed by the weakness of the bears and by the strength of the bulls. You're now concerned that the bear trend might be transitioning into a trading range. And therefore, you'll look to get out near the bottom of the developing range. For example, had you sold at the high of this bar and you see a pair of good bull bars like this, you'll try to get out around break even. And look what happened here. When the market got back to that high, it rallied again. The bears are getting weaker, the bulls are getting stronger, and the market's probably transitioning from a tight bear channel into a trading range. And the bulls will start buying reversals. Is this a lower low major trend reversal? Well, it might be. I said there might not be enough bars down, but it was so climactic that it might be. More likely, it's going to be a bigger minor reversal. However, at some point, after 3, 4, 5 bull bars, it's always in long, no longer always in short, and likely to go higher. However, it could be transitioning into a broad bear channel, a very tight bear channel, and we could be getting deeper pullbacks, yet continuing down to a new low. And therefore, this could be a bull leg and a broad bear channel. It's clearly a bull leg and a trading range. We have a trading range here, and this entire area of 40 or 50 bars might be a trading range. Bulls made money buying at this low and went up far enough for them to make money. Well, Because of that, bulls will place limit orders to buy at this low, betting that we'll rally here as well. We're getting trading range price action. After every strong breakout, especially if it goes to a new low, traders should trail their stops. Move their stop down to 1 pip above the most recent major lower high. You have a strong breakout, a new low, follow through bar. At this point, traders will put their stop 1 pip above the top of this bear leg. So 1 pip up there. It doesn't matter if they sold here or sold here or sold here. Once you get the breakout and the follow through and the new low, the stop goes here. And the same is true with any of this. For example, we got a strong bear bar, a little bit of follow through. That makes this lower high fairly major. You could still rely on this high or that high, but this one's fairly major. If it's in a bear trend, it should not get above that lower high. If you're selling for any reason, even if you sold down here and it goes above this high, you're going to conclude it's no longer in a tight bear channel, and therefore you're going to be trading it differently. So it's appropriate to get out if it goes above this bar. It's a major lower high. If the bear trend is no longer making a series of lower highs, then it's no longer in a bear trend. It could be in a bull trend, but more likely a tight bear channel will transition into a trading range before it can transition into a bull trend. If you see a breakout like this and then we get a bull bar like this and you're wondering, is this a major lower high? It's only a 1 bar bear breakout and this rally was not particularly strong. It's not really major. I think this is a minor lower high. And the same with this. Is this a major lower high right here? We have a bear breakout and a follow through bar, but it's in a very tight bear channel. And therefore this might be minor, could be major, might be minor. You could put your stop there or here, or even here for that matter. And if it goes above it, yet you think the bear trend is still in effect, you can look to sell again on a reversal down. So a bear who sold here or who sold here, doesn't matter where you sell, and he chose this for his stop, and he gets out, he'll look to sell again on a reversal down, like here for a double top or below that bear bar. Let's say you're a bear and you like to scalp and you see a strong breakout like this. It's still better to use the most recent major lower high for your stop, even if it's far away. I say that because a lot of scalpers will scale in if the market goes against them and they need room to scale in. And then the stop might be further away than what you think is logical. If you're scalping for 10 pips, sometimes you have to risk 20 or more pips and be willing to scale in to have a good strategy. When a trend is in a tight channel like this, it's better to be swing trading at least part, if not all, of your position. Again, it's important to realize it does not matter where you enter your trade. Your entry price has nothing to do with your stop. If you sold up here and the market is now here, your stop is here. You trail your stop down. After every new strong breakout to a new low, the stop goes 1 pip above the high of that leg. Strong breakout, stop up here. Strong breakout, stop up here. And again, it does not matter if you sold at the low or if you sold up here. At this point, your stop is here. Again, it doesn't matter which of these short entries you took. At this point, somewhere in here, the stop is here. At this point, at here or here, whether you sold there or there, stop is up here. The stop is the same for all of these entries. At this point, it doesn't matter which of these sell entries you took, your stop is still up here. As I said, if you use the tighter stop after a pair of bear bars and a follow-through bar, you sell again if the bear trend resumes down. When you have a choice like this between a tighter stop and a wider stop, both are reasonable. And if you take the same trade 10 times using the tight stop, your profit after those 10 trades would be about the same as a trader who used the wider stop. This trader would get stopped out much less often. When he did, he would lose more pips. This trader gets stopped out more often, but with a smaller loss each time. And both are reasonable. And when you take reasonable trades, it doesn't matter whether you use the tighter stop or the wider stop, your profit will be about the same after 10 or 20 trades. Both are okay. In every trade, you always need a plan to take profits, because if you do not, the market eventually will go against you and your profits will disappear. Strong breakout and follow through, possible measuring gap. So if you sold this close, it's always reasonable to swing at least part of your trade. It's a trend, a bear trend, and the probability of making a reward at least as big as your actual risk is 60% if you use the correct stop. Let's say you took this sell on the close of this bar. You might put your stop above the top of this 3-bar breakout, and that is your initial risk. Initially, you're willing to risk to 1 pip above the high of that bar. However, once the market started to turn down, you know that you actually had to risk only 1 pip above the high of this bar. You never know what your actual risk is until the trend resumes. Then you look at the highest pullback after you entered, and your actual risk is 1 pip to above that high. To have a positive trader's equation, the minimum profit that you need is 1 times your actual risk when the market's in a trend. When the market's in a trend, the probability of making money is high, 60% or greater, and you'll have a positive trader's equation as long as you go for a profit that's at least 1 times bigger than your actual risk. You sold here, it's starting to go down, you know your actual risk is here. You could take your entire profit right here and have a positive trader's equation, 1 times your actual risk. However, you also need to be taking a profit that is at least as big as a minimum scalp. And this is less than 10 pips, and therefore you should not exit here. Alternatively, when the actual risk is small, less than the size of a minimum scalp, some traders will take profits at 1 times initial risk, the distance from their entry price to their initial stop. And here's 1 times initial risk. And you can see what took place down here. We're starting to hesitate. And that tells you that some of the traders who sold this breakout are taking profits at 1 times their initial risk. I measured move down based upon the height of that breakout bar, or that breakout series of bars. Initial risk is 1 pip above the high of this bear breakout. If you sold at the low of that bear breakout, that's where your stop is. The actual risk turned out to be 1 pip above the high of this 1-bar pullback. The math is always good if you scalp at least part of your position at 1 times actual risk or 1 times initial risk and swing the rest. When a trend is strong like this, I would not exit at 1 times actual risk, especially since it's less than a minimum scalp size. However, taking partial profits at 1 times initial risk makes sense. And look what happened here. A whole bunch of bears were buying back shorts. In general, let's say you did scalp part at 1 times initial risk. You would have made more than 20 pips, which is good, especially for a day trade. A lot of bears will continue to hold at least part of their position short until there are at least 2 reasons for significant support. And then they could exit with a limit order at that support or on a reversal up from that support, especially if there was a second reversal up from that support. All trends eventually end, even strong trends. Bear channels usually transition into trading ranges, and then once it's in a trading range, the bulls have a higher probability of getting a reversal up, maybe a 40% probability of a reversal up. Once the market is no longer in a tight channel, you have to trade it differently, and that means you have to be starting to take profits. You trade it like a channel until it's no longer in a channel. You keep selling for any reason, you use the most recent major lower high for a stop, and you hold. You can take profits at least one times actual risk as long as your profit is at least as big as a minimum scalp, 10 pips. However, when the market's falling in a very tight channel like this, it's going to fall further. High probability, 60 or 70%. I would be not too quick to take profits. I would try to swing as much as I could and as long as I could. After a trend lasts 20 or more bars, the risk of transitioning into a trading range starts to go up. And therefore, after it's gone on for about 20 bars, traders start to look for signs that it might be transitioning into a trading range. This is not enough to make traders think we're going to get much of a trading range. However, this is enough, especially with follow through like this. We have a bear break below a bear channel. You get a reversal up 70% of the time, to at least to the top of the channel. And then I said earlier that this was a surprisingly big breakout, a pair of big bear bars breaking below a range. It has follow through selling, so it's probably a measuring gap. So I looked to the left to see where the top of the bear trend was, and I looked for a measured move down. You could either take the measurement from the middle of the bear breakout or from the breakout point from here. If I use the breakout point, the measured move target would be around here, and you can see traders took profits there. This is a support area. The bottom of a bear channel is a support area. This is the biggest bear breakout in more than 20 bars. In fact, probably the biggest bear bar in 30 or 40 bars. And therefore, it's more likely an exhaustive end of the trend than the start of an even stronger leg down. This is a sign that the market might be transitioning from a trend into a trading range. The bears might be exhausted and they may wait for 10 or more bars of sideways to up trading before they sell again. Starting to get a tight trading range with doji bars, a bull bar closing there, it's open, a bar closing there, it's open, bar closing there, it's open. And it's late in a trend, it might be a final bear flag that would lead to a reversal into a trading range, less likely a reversal into a bull trend. Usually when you get a sell climax and a final flag and the channel is still tight, the odds are the best the bulls will get is a trading range. However, the probability is going up that the bulls will get a trading range. Strong bull reversal and a decent follow-through bar, and therefore a final flag might get two legs up, one pullback two. Now we got a strong bear breakout, immediate reversal up at the prior low, and we have a good reversal bar reversing this bear bar. And now we're getting 2, 3, 4 consecutive bull bars. The market's always in long, which means after a pullback, it'll probably get at least a second leg up. If you're short for any reason, this is a reasonable location to exit. A new low and a reversal up after a strong reversal here. Again, you're at a measured move based upon this breakout. You're at the bottom of a channel. You have a potential final flag. You had a pretty strong minor reversal here. the market's probably transitioning into a trading range. Can you buy here? Well, you can, because it's probably evolving into a trading range and you're buying near the low. However, I think if you're short, this is a good area to exit. Remember, if you're short in a bear trend and you get a minor buy signal, bears are going to exit. Bulls might not buy. Bulls like to see stronger buy signals, but bears will exit on even a minor reversal if there are several reasons for the trend to be transitioning into a trading range. Possible lower low major trend reversal, as I said, but not really enough bars, and therefore probably transitioning into a trading range instead of a bull trend. It went always in long, but the breakout, even though it has a lot of bull bars, it's lacking consecutive big bull bars, not much energy, so it's probably a bull leg in what will become a trading range. After 3, 4, or 5 consecutive bull bars and lots of reasons for the bear trend to be ending, bulls will buy. We're always in long. Chances are we're going higher. If a bull did not buy the close of this 3rd, 4th, or 5th bar, they might buy a high 2 buy. We tried to go up, we failed. We're trying to go up a second time. A second leg up is likely, so some bulls will buy with a stop. Very tight bear channel. You can draw a trend line after this reversal down, and the market broke above that trend line. We reversed down again here, so you could draw another bear trend line, and we broke above it here. Market reversed down here, you could draw a trend line here. This trend line is not especially reliable because the spacing is not symmetrical. The number of bars between 0.1 and 0.2 far less than the number of bars to 0.3. So this line is not that useful. Strong reversal down. Traders will look for another reversal down and they'll draw another line. And you see what's happening? Every breakout above a prior line creates a flatter trend line. It's a sign that the trend is becoming less steep, less vertical, and we're becoming more horizontal, starting to transition into a trading range. Another trend line with these two highs. Market's trying to reverse down, but did not reverse much. Also, at this point, it's already always in long, so we're probably going to break above that trend line. We already have a trading range here. 20 bars sideways, multiple reversals. And at this point, you can see the market has transitioned into a bigger trading range. At the time, you did not know that this was a bear leg in a trading range. However, once you got a bull leg and a reversal down, you know that this is actually a bear leg in a trading range. This is a bull leg in a trading range, and this is another bear leg in a trading range. It's still a tight bear channel at this point. However, it's also a trading range, although you didn't know it at the time. Markets transition, and when a market's transitioning, it's often in a bear trend, a bull trend, and a trading range all at the same time. The market rarely ever goes from bear trend to bull trend. It usually has to transition into a trading range before it can become a bull trend. At this point, the market's in breakout mode. The bears see a bear trend, a trading range. They want trend resumption down. The bulls see a bear trend and a trading range, and they want a trend reversal up. 50-50 chance the bulls will win, 50-50 chance the bears will win. Once the trading range grows to 30, 40, 50 bars, it becomes almost as bullish as it is bearish. There will be decent buy signals and decent sell signals. As soon as a bear trend goes on for about 20 bars, look for signs of it transitioning into a trading range. Most of the time, those minor reversals will fail and the bear trend will continue. But when you start to get stronger reversals up, especially at support, the odds are the bear trend is ending and a trading range is beginning. And it's important to know that because you're going to trade it differently. First reversal up, even if it's strong, still probably becomes a bear flag. At some point in here, you have to stop trading it like a bear trend because while it could still be a broad bear channel and make a new low, it's mostly a trading range, and traders should look to buy low, sell high, and take quick profits because it's unlikely to go very far up or down. At this point, 50% chance we'll get a reversal up, expanding triangle, low, lower, lower. 50% chance we're going to continue down in another bear channel. All channels eventually end. This is a fairly broad bear channel at this point. At this point, it's still tight. When you have a channel, I always look at a bear channel as a bull flag. That means 75% chance I expect a bull break above the top of the channel, only a 25% chance of a bear break below the bottom of the channel, and then an even stronger bear trend. It's fairly common for a tight bear channel to evolve into a broad bear channel and then evolve into a trading range. Very tight bear channel. In fact, this entire trend is a tight bear channel. However, this pullback is pretty tall, and we're getting another big reversal up and another big reversal up. This is also a broad bear channel at this point, and you start to trade that more the way you trade a trading range. A tight bear channel is a very strong bear trend, and you only want to sell. But if the market is having strong reversals up and the channel is now broad, bulls will start buying for scalps as well as bears selling. A tight bear channel is a very strong bear trend, and you have to sell. And I talk about lots of ways to get short. After every strong breakout to a new low, you have a new major lower high. You should trail your stop to above the most recent major lower high. Because all trends eventually end, you have to have a plan to take profits. If there are several reasons that the market might be transitioning into a trading range, traders have to be looking to take profits because all trends eventually end. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading tight bear channels.